How to vet a deal sponsor. What sophisticated investors actually check. Most people vet the deal. They study the projected returns, the market, the property. But the deal is just a prediction. The sponsor is the person that's going to make or break the deal. And if the sponsor is wrong or dishonest, none of the predictions actually mean anything. You're not investing in a building. You're investing in the people that are running it. This episode is about how to pick the right sponsors, how to vet them, and to ignore just the pitch. Stay tuned. Welcome to Growing Empires. I'm Jennifer DeJesus, real estate investor and operator. This show takes you behind the scenes of how real estate assets are executed, managed, and positioned for long-term performance. Let's get into it. The most important thing to find out when vetting a sponsor or looking at a deal is the track record. And this is the piece that I find most investors don't even ask for. Anyone can show you their wins, but the real question is what is happening when deals don't go as planned. Ask to see the full track record, not just their highlight reel. Because inside, when you dig deep, is going to be a wealth of information that should tell you to either lock in and trust the sponsors or run the opposite way. You also have to look at how many full cycles they've been through. And what does a full cycle mean? Full cycle means they underwrote the deal, took it through due diligence, purchased the investment, and executed on the business plan, whatever that looked like. So if it was a 5-year hold, an 8-year hold, whatever it may be, and then they exited the property cleanly with investors receiving the returns that they had anticipated when they invested. Full cycle also means that they were adhering to their business plan the entire way. They didn't have to pivot because the deal went bad. Or if they did have to pivot, what was the outcome of that? Has the sponsor only ever done business in a rising market? Because if that's the case, they don't know how to weather storms. A sponsor who can only operate in good times hasn't been tested. You want somebody who manages a deal even when it goes sideways, and they can tell you exactly what they did about it. One of the things that I've always done in business is be honest and be forthright in anything that's happening, good, bad, or indifferent. I own up to my mistakes. I learn from those mistakes, and I make sure that everybody has full transparency on the deal. I had to recently walk away from a partnership because my partners chose not to be transparent. They chose to make excuses for problems that were happening. They didn't want to honor their commitments. They didn't want to identify or be honest about their underwriting and that they bought a bad deal. And instead of just hunkering down, working as a true partnership and managing the deal that went sideways for the benefit of all the investors, they chose to make excuses, put blame, and not own up to the mistakes. So I had to separate myself because that is not the type of business I would like to run. And it's not something I want to be known for. When you're vetting a sponsor or a partner, for that matter, I can tell you that you want to know just as much about the losses as you do the wins. Because the losses or the deals that go sideways that they're willing to talk about and what they did about it show their true character, they show their true expertise, and it shows if you're going to have a partner when things don't go as planned. Anybody can put together a good thesis. Anybody could put together a good OM, and anybody could put together a really great pitch deck. That sounds wonderful. But a lot of times when things are too good to be true, they really are too good to be true. What is your sponsor's instincts when things go wrong? And if they tell you that they haven't had any deals go south, they're lying, or they've never experienced a market that has shifted. Shifts don't happen far in advance. Sometimes market shifts are unwilling to give you a heads up. Sometimes those market shifts impact occupancy. Sometimes those market shifts impact jobs. Sometimes those market shifts impact licensing and regulations and things that maybe you'd never thought of. Think of like tax assessments. Do you see those things coming? Not always. If the deal was underwritten appropriately from the start, I can assure you that there's a caveat or a backup of reserves to weather certain storms. But that's another thing that you want to look at when you're looking at any kind of deal is your operator, is your sponsor sophisticated enough to build in reserves, and what are those reserves for? And I'm not just talking general repairs and maintenance. I'm talking about when something really goes wrong in a deal, because those things could really happen. Is there enough resources in place? Is there enough reserves to weather those storms? The next thing to consider about a sponsor is alignment. And the alignment is about how do they make money? Do they make money when you don't? I don't consider that to be alignment. That's where you separate operators from promoters. Promoters are people that sell the deal. They've got the great sales pitches. They're the marketing gurus. But the sponsor is compensated, or should be compensated, when the deal performs, not when it underperforms. So are they taking their fees up front? Are they taking their fees regardless of the outcome? Or is their upside and their financial benefit tied to performance? Is it tied to your return through the waterfall at the end of the deal? Are they investing their own money alongside of yours? You should be very weary of a sponsor that doesn't have their time, their money invested in a deal. And I don't just mean the management of it. What resources are they bringing to the table to make sure that there's a benefit for everybody? Do they have their money invested? If they don't have their money invested, or if it's not the type of deal that they would invest in, you probably shouldn't either. A sponsor that has nothing to risk and gets fat on acquisition fees is not the type of sponsor that you want running your deals, because they get paid whether you win or lose. And that's why, unfortunately, the multifamily space has gotten such a negative rap lately, because there was no shortage of sponsors that were being compensated for deals. They were not operators. They were promoters that were getting paid regardless. And as soon as they got paid on the acquisition fees, they moved on to the next deal that they were promoting. They were not the operators. They were not the ones responsible for the deal. They were moving on to the next greatest acquisition fee because they were not responsible for operating the deal. You want to know if your sponsors are operating the deal and what is each of their specific roles, especially if there's more than one. What does that partnership look like? Because if the partnership goes south, even if the deal doesn't go south, you can be in for a world of disappointment on your real estate investments. So back to the alignment. How are they paid? What are they going to do if something goes wrong? And how quickly will you find out? How willing are they to provide you with financial reporting? One of the things that we do in the Empire Capital Fund is full transparency. I have always made it my mission to make sure that I'm having conversations versus sending emails. What is the sponsor's preferred method of communication? Are they going to just text and email you updates? Are they going to copy and paste from ChatGPT the updates that are being sent to you? Or are they willing to get on a call and have a quarterly conversation, or more often if the deal makes sense for such? Are they willing to get on a call and let you ask questions? Are they willing to tell you the good, the bad, and the ugly? Ask for some references. Ask for people that have been in deals with them previously, and ask for the referrals. And I assure you that that is going to help you vet a sponsor very carefully. From people that have been in full cycle deals, that have experienced the operator and the sponsor from start to finish. And if you can find a few of those people to talk to, it'll give you a much clearer picture on who that sponsor is and who that sponsor's team is. Next is, do they actually operate, or do they just raise and outsource? A deal in itself, from underwriting to purchase, is not a win or a loss. The win or the loss comes from the actual operations. It is the single most critical factor of any deal. So who is operating the deal? If you can trust the operator, you can trust pretty much anything about the deal. If they are outsourcing their operations, who are they outsourcing to? Do they have a track record with that company? Most people that have been in deals that have gone south will tell you the single biggest reason that deals have gone south was because of the operations. They couldn't handle vacancies as they came up. They couldn't handle repairs and maintenance efficiently. There was too much time on a turnover or marketing of a unit. They couldn't handle delinquencies. And there's a variety of other reasons. But who is actually operating that deal? And again, if they are they outsourcing to a company that they're doing business with the first time? Because now you're not only trusting in your ability to identify if the sponsor is right, now you're trusting your sponsor has the right resources to identify who they're outsourcing the property management to. That could be a very, very risky proposition in any deal. So you want to make sure that you are involving yourself in deals where you know the operator or you have experience with the operator, that it's not just an outsourced problem that then the sponsor is going to use to blame when something goes wrong. You want to make sure you know who is truly operating the deal, who is making sure that the vacancies are filled, who is making sure that maintenance and repairs are handled appropriately, and what's their experience in the market. Do they have experience in this asset class? What are some of their qualifications in years in business? When something goes wrong, it's 11 p.m. at night. Who on the sponsor's team is going to answer the call? That's another great question, because if they're outsourcing or if there's a property management company in place, assuming that the property management company doesn't have the full autonomy or authority to just make decisions, who on the sponsor's team is going to get that call in the middle of the night and make a decision? As a vertically integrated operator who controls everything, we control how the deal performs. We don't outsource promises. We manufacture returns for people. I have raised money for deals. I have personally vetted my own money for deals. I operate the deals. And I make sure that there's very limited or no middleman in anything that I do. Because when I can control from start to finish the operations of a property, I know I can control the outcome. I know that I have the resources and the sophistication to deal with and weather all storms, because I've experienced personally and professional several different market cycles, and we've been able to get through all of them with a positive outcome. Spend some time talking to your sponsor or the operator about some of their most recent experiences and storms that they've had to weather in the market and how it impacted the returns and what they did to get through those things. Transparency and communication. This is something that you need to dive very deep on when you're vetting a sponsor. How is a sponsor going to communicate with you? Again, I gave the illustration of that email, that ChatGPT email full of nonsense. Are they going to answer the hard questions? What is going to happen when things get a little slippery? Are they going to direct your questions to somebody else on the team? Or are they going to have a conversation with you and physically show you the reporting? A sponsor who communicates in good times and bad is exactly the type of sponsor that you want. Vagueness is never a good thing when it comes to your investments or your sponsors. So many times I've heard investors talk about deals that have gone bad and how the sponsors have been almost become silent. When there's a gap of time and things are not consistently on a calendar, things are going sideways behind the scenes and you may not even be aware. Again, one of the reasons that as a sponsor of the Empire Capital Fund, the managing member, it's important to me to make sure that I have regular accountability conversations with all of the investors, and we do it quarterly, and we do it by Zoom. They can see me, they can hear me, they can feel my energy or my concern, and it gives them an opportunity to ask questions. And these are things I put on calendars, and I've never once canceled, because I believe in the transparency and I believe in talking about everything that is going on with somebody's money. I take the steward of capital very, very serious. So deal level questions, how are those things being answered? Deal level questions go about the underwriting. The underwriting is going to tell you a very, very big piece of the puzzle. What are they projecting as far as rent growth and exit cap rate? And where did they get that information from? How do you know that the numbers that they're projecting, if you are not a seasoned or sophisticated investor, or maybe even if you are, but you don't know necessarily the market that you're investing in, how do you know if the projections that they're using, the rent growth, the exit cap rates, the timelines, how do you know if those assumptions are aggressive or if they're actually conservative? What is the debt? What happens if the rates move? What if the loan comes due in a bad market? Ask them to walk you through the downside cases and watch whether or not they have an answer for those things. That again will tell you how sophisticated this sponsor is and how many storms they've weathered. Because you have to plan for everything. Every investment comes with some sort of challenge. There is no such thing as a perfect deal. There's no such thing as the investment that never has any kind of issues. Now, the issues may be on a very small scale, or maybe something changed drastically in the debt structure. But a sponsor who's only modeled the upside is telling you a story that is very much fake and phony. You need the sponsor to be able to tell you not only the upside, but to tell you the what ifs. What if this has happened? I encourage you as you're vetting a sponsor to ask a lot of questions. Ask a lot of questions about the underwriting. Ask a lot of questions about the projections, the exit. What happens when things go sideways? How are they going to navigate it? Who are the sponsors? Who are the partners? Who is running the deal? And who is overseeing the management? And who are the actual operators? You don't need to be an expert to do this. You need to be the person that asks the right questions, and you need to watch how somebody responds under pressure. The answers matter, but the way that they handle the questions is going to speak volumes about the authenticity of this sponsor and your potential investment partner. A good sponsor, a great sponsor, is going to welcome the scrutiny. They're going to welcome the questions. If they get upset or visibly annoyed, you can tell that they were not experienced enough to answer those questions, and it's probably somebody that you want to stay away from. When you're comparing deals, you also don't want to just compare the returns, the equity multiples. If you're looking at your IRR or your cap rates or your equity multiples, whatever you use personally to identify whether the deal is a good deal or a bad deal, you do not want to just compare that number from deal to deal, because the business plan or the business projections impact those returns. So if I'm looking at a series of, let's just say 3 or 4 deals that I could potentially invest my money in, and what's most important to me is the equity multiple. I want to know over time how many times I could double my money. And we're just going to use that as an example. If I'm looking at deal A and deal A has a 2x multiple, deal B has a 3x multiple, and deal 4 has a 5x multiple. And again, I'm just giving examples for the sake of illustration. You do not necessarily want to just jump to deal C with the 5x multiple. Why? Because all the projections along that, the business plan, they impact those returns. So if you're investing in a deal that is too good to be true, likely it is, but if you're not investing in something that you understand the entire projections to, just the fancy sticker with the flashing lights on the surface are the things that could potentially have you investing in the wrong deal. Where did they get those projections? What are the things that they're using to identify those projections? Again, what is the rent growth? What is the cap or the exit rate? And what does that mean for the market? Is it similar in the market? Have you vetted those numbers against other deals that have performed in that specific market? Can they give you examples of deals that they have done in a specific market that have performed well? Because if you're just testing your money in a new market or a new sponsor or a new operator, you're really throwing your money to the wolves. And only time will tell if you're going to get that money back. The things that I leave you with is questions that you should be asking every sponsor. Has the sponsor been through full cycle? Or have they only been in good markets? Ask them what markets and how long they've been in business. When the deal underperforms, as they do, who gets paid? When does the sponsor make money? And what happens if the deal is going south? Are their returns affected as well? Do they operate the deal or do they just raise for it? Who is operating the deal? Is it somebody in-house that's part of the GP team, or is this somebody they're outsourcing to? And if they're outsourcing the services for the operations, have they used that operator before? And how did they vet that operator to make sure that they were going to always have your investments top of mind? Keep in mind that the deal is a promise. Vetting the sponsor is how you find out whether the promise is going to be kept. I hope you enjoyed today's episode, and I hope this helps as you're vetting future opportunities. Until next time, take care. That's it for now. If passive income from real estate investments plays a role in your long-term investment strategy, this show is for you. Thanks for listening. And for more in-depth resources, please head over to growingempires.com.